Hey everybody, it's me, JJ Panzer, your smart apartment advisor here with the Real Management Company, back for another weekly client call to talk about a couple of interesting and timely pieces of information. I hope everybody had a good, safe, and quiet Thanksgiving at home, or in some other fashion that was able to keep the spread of COVID down. Um, I've got a couple of things to discuss today, but really the most important thing is the passage last night of the rent registry legislation at the Board of Supervisors, which is not at all surprising, and definitely disappointing to see where this is going. And I was hoping that Denise would be here to sort of give me a little bit of perspective on this, but I'm going to share my thoughts and the details of the legislation. I just got the email from the Apartment Association talking about what this is going to require. And I'm going to pull this up and go over some of the details with you here. Basically, this rent registry is going to be extremely complicated, and it's going to be expensive for everybody, including tenants, hopefully, but that's not at all a guarantee. To create and administer this housing registry, it's going to probably involve something like a tripling of the rent board fee that we're already paying. And as you know, right now there's a split of who is paying for the rent board fee, and you get to deduct half of the cost of the rent board fee from your tenant's security deposit interest if it gets paid on an annual basis or at the end of their tenancy. Or you can just bill them for it. And then, so this is probably going to increase that. I think it's $21, $22, $25 a unit per year. It's going to be a lot more expensive. And I noticed, I was looking at some buildings in Berkeley, and Josh, correct me if I'm wrong, or, let me know if I'm right. I think Berkeley's rent board fee is something like 3 times San Francisco's. I think it's like $100 a unit a year. And oh, there's Denise. There she is. All right. Denise, there you are. How are you? I was just getting started on my my overview of the rent registry ordinance, and I'm glad to see that you're here, because this will give me your perspective on this. But I was going over the details and talking about the rent board fee and the fact that it's probably going to have to be significantly increased, probably to something like triple, in order to compensate for the added workload for the rent board. And let me just switch this over here. Hold on. Well, okay, let me do, I'm not sure why it's showing me Karen's telephone on my screen. Does everybody see me or Karen and her telephone on your screen? Anybody?
I see you.
You see me. Okay, good. So anyway, yeah, the rent registry is going to be requiring all the housing providers beginning in 2022, which is all of us, to report the address of each apartment, the contact information for the building owner and manager, business registration number, square footage, number of bedrooms and bathrooms, when the unit was last vacant, when vacant units were last occupied, occupied units, the date the tenancy began, base rent in $250 increments, any dates over the last 12 months where an occupied unit became vacant or a vacant unit was occupied, and anything else deemed appropriate by the rent board. And obviously, the first piece of concern that I have over this is that's a lot of information to report for a lot of units for a lot of my clients, and it's going to be a lot of work to report. And so, we're going to have some talks, my staff and I and all of you, about how do we comply with all of this and account for all the time and energy it's going to take. But I think the bigger question, and this is where Denise comes into the picture, is that what is the political desire behind this? Because it's obvious that this is a part of having a supermajority recalcitrant board of supervisors who seems to think that all housing woes are directly caused by our greed in charging market rents for our apartments, when it's a lot larger than that, and most of it is actually their cause in having to do with the fact that, well, in a structural way, the housing market does not respond to demand. Demand goes up very, very fast, and housing is very, very slow to build. And number two, they are not very willing to allow people to build more housing because a lot of that is owner occupied, and homeowners don't vote for these supervisors, and higher end housing does not further their electoral politics. But it's depressing, and it's still a year off, but it is unfortunate. Denise, what are your thoughts about all of this?
Well, I think that first of all, it was in response to assuming that Costa-Hawkins was going to fail. In other words, that Costa-Hawkins was going to be repealed. So
right.
I think that they assumed that there was going to be vacancy control, and that was the purpose of it. And so now there's really no purpose for it, right? I mean,
right.
Right. And so I don't know if it's, but the wheels of justice have begun. And so they have proceeded to pass the ordinance. My concern is at the very end, if you read the ordinance, there's what happens if you don't do it right. If you miscalculate, if you miss a month, if you accidentally miss a year or whatever you're doing, and the documentation is not proper, then the tenant has the right not to pay any increase until such time as the owner decides to comply with the requirements. But what if the compliance of the requirements is a different definition between the city and the owner? So then the fight is on, and can the tenants use it as a defense to any unlawful detainer for non-payment or any other issue? We don't know. We don't know how that's going to play out. Obviously, they will try to do so. So that's something that we need to be very cognizant of.
And as you're alluding to here, a tenant, if there's an illegally served rent increase, they can. In some circumstances, they would use that as a defense in an unlawful detainer and say, this landlord is doing things incorrectly, and they're being, they're flouting the law in all kinds of different ways. And the penalty for non-compliance is that you don't get your registration, your license to operate your housing, in which case your tenants can then say, well, gee, you're operating your business illegally, and therefore you cannot collect rent, which is a big penalty for not providing this kind of information. And it seems like another potential end game from this is a vacancy tax, which for any of us, we're pretty quick and responsive to trying to get our vacant units rented because we're really in this business. But I can definitely see situations like people with an in-law apartment, a legal in-law apartment in their homes, who decide they don't want to rent that in-law apartment, then they have to pay a tax in exchange for the not renting of their own unit if they want to keep it for their occupancy, or I guess they could be not in compliance and then not renting, and then they're not in any danger in that circumstance. Is that correct?
Who knows?
Who knows? Yeah.
We don't know. And what if you have an agreement with someone and they don't pay rent, but there's another form of remuneration? So you have not a tenant necessarily, but what if you have a nanny? What if you have somebody who's a caregiver to an elderly person and they're living there for free? Is it vacant? No. Is somebody paying remuneration to the owner? No, because it's an exchange of services. So it's fraught with problems.
And I guess we're going to spend the next year negotiating over these problems with people who don't have to negotiate with us.
Right. Well, and also, why negotiate anything if it's not right? It's not in place yet. So I don't think that they're even going to listen to any discussion, any logic to it until such time as it's implemented. Yeah,
it is. It's a lot of paperwork and a lot of work for no good purpose, especially given that we were able to prevail against the repeal of Costa-Hawkins in Prop 21. are you, I guess after having fought this battle twice in 2 years, 3 years, and won both times because and the interesting article from what was it, the Tenderloin Housing Clinic founder on his blog talked.
Andy Shaw.
Yeah, Randy talked about that in the week of the election. He said, well, we're going to lose because this is not how you fight this kind of fight. You don't just throw money at it. You have to have a grassroots effort. Do you think we're going to see this come back again soon? Do you think that
Yeah,
you do?
every year, right? Why not?
Yeah.
I mean, the politicians being as who they are, of course,
Right.
we're going to drive the construction industry out of California. And then what are we going to do?
We're going to have a welfare state.
It's not sustainable. So
No, not in
that's
the
what
long
people
run.
have to understand. Yeah.
Yeah, it's difficult to imagine we're going to be the experiment in socialism here in California for the foreseeable future. And we have to hang on to what we've got. I mean, I don't know I'm not even sure what advice I would give to all of you, to, housing investors in rental housing, as far as, what's life going to be like 10 or 20 years from now. Because it doesn't seem like our right to do this and make a living at it is going to be respected. That this is going to be a public good. We're going to be regulated like a utility, and then forced out of business. So I don't know. It's really kind of upsetting and sad. This has been for generations a good, honest, hardworking people's way to make a living, and the political forces around it have made it. They keep interfering with what we're doing. So, well, anyway, with that happy piece of information, my goodness, Josh has an update on actually on a previous deal of the day that he did, and some information based on a conversation. Was it with an investor, Josh, about this a specific property that was on the deal of the day and then is back on the market?
Yeah, there's a back on the market deal, and then I also I sat in on a conversation, a Zoom call with some investors and 3 lenders, local lenders, and so I wanted to share some information on the apartment lending market to just give you a snapshot of where those guys are at.
Okay, sounds good.
Can I get a share screen?
Yeah, go ahead. It's all set.
Cool. See that sheet?
Yep.
Cool. So this was a talk yesterday with Fremont Bank, Luther Bank, and a CBRE affiliated lender with Fannie Mae, doing Fannie Mae, Freddie Mac loans. It was just kind of a snapshot in terms of where they're at on lending on multifamily in the area, doing East Bay and San Francisco loans. So the big question that came up is how have your lending standards changed since COVID? So a few changes they've had are they're asking for reserve accounts. So when you get a new loan, you have to have a reserve account of 6 to 12 months of payment reserves put away. That's new. They just want to make sure you can pay through this pandemic, basically. Their LTV, their loan to value, has dropped a bit. A couple of the lenders talked about a 5% drop, whereas a year ago they could do 75% LTV. Now they're doing 70% LTV. The big kind of change in my mind is the vacancy factor that they use when they underwrite buildings. So they always, normally it's 2 to 3%. They consider a vacancy factor to account for move in, move out times, and that you're not earning those rents. So they deduct that amount from your gross rent. They've moved that up to like a 5% vacancy factor to account for the longer times it's taking to rent units. So that's a change. So what that means essentially is you're getting less value for the rent that you're taking in when they put a higher vacancy factor on it, therefore less loan value, less loan proceeds. there was an interesting question in terms of concessions. So there's all these concessions happening in the market, right? All these landlords, including us, offering 1 month free or whatever it may be to entice renters. And the banks, when they catch wind of this, it's fine with them. They don't have a problem with it. But the way they underwrite for it is they increase that vacancy factor that I mentioned before. So they just say that, you know, again, they're kind of dinging you on the, you know, decreased rent. So they say they increase the vacancy factor 1 to 2% when they see concessions. My experience would be, if I was offering concessions, I don't know if I'd offer that information up. I would say, here's what my rent is. But maybe, you know, you have 3 units on the market and they can see it or whatever it is. But so that's kind of ways they've tinkered to account for what's going on. So those changes they're not massive, right? But they are changes. You're getting kind of less money. You're getting you know, the payment reserve account is tough for some people. You're having to put up an account that shows all that payment. But you should probably have that money anyway. So that's kind of how those things have changed. Then they were asked, are you aggressively seeking new business? What's your, you know, what are these banks' position? It was an emphatic yes from all 3 of them. They are aggressively seeking out new business and new deals. So there's money flowing behind these guys. The rates right now are 3 to 3.5% for apartment loans. So that's, you know, anybody who's considering a refi right now, I think the timing's great. I think, you know, we should be going to some of these folks and talking about refis. Obviously, with vacancies in our units, that makes things complicated to get a refi. But if you're full, these guys are lending, so that's great. They're funding in about 60 days. Their debt coverage ratio is, you know, I don't want to get too deep in the weeds, but it's just a relationship between net operating income and the debt service. So net operating income over debt service, annual debt service is a ratio that comes up to between 1.15 to 1.25 is what they're looking for. I asked about defaults. If, you know, locally, what are they seeing? A lot of defaults, delayed payments, foreclosures, whatever it may be. And they said very, very few defaults in their portfolios. CBRE guy was at actually a 0.03% default rate. So so the loans are performing, people aren't collapsing. There was some, when we started talking about, so people have obviously had problems this year. When you move into 2021, there is some nervousness that they expressed that, you know, it's all a question of how long this all goes on for. And so if you get more vacancies, or if you're getting people who are not paying rent or whatever it is, if these things extend well into the next year, there's some folks that are kind of on the bubble that there's some concern there. So that doesn't, but they're still bullish. They still are out there lending. And so they're okay. But some nervousness there. What they're doing is, when they're seeing a borrower in trouble, they're really just kind of trying to reach out to them directly and say, hey, or, you know, they find out from the borrower, but they really try to jump in and offer assistance. And they, you know, the basic feeling is we're getting pretty close to, I mean, some people say we're on the 50-yard line, we're halfway through this, but with the vaccine kind of on the way, we can kind of see light at the end of the tunnel. So I think that the lenders are going to be offering more assistance, being that it's potentially short-term assistance, was what I kind of took away from that. And so I thought this was just an interesting snapshot of what's going on with local lenders here. And no, you know, it wasn't doom and gloom. It was a few ways to tinker to adjust their underwriting standards and still out there lending. So that's that piece. Anybody have any questions about apartment loans right now or anything? I can move on to a deal that came back on the market. No? Okay. So this is a property that I really loved a while ago. It went into contract, I think, in August, and it was in contract for quite a long time, and recently fell out of contract. So this is
Oh,
that building. It's 12 units on Claremont Ave, right across the street from the Claremont Hotel in Berkeley. A lot of deferred maintenance, all 1-bedroom units. Nice classical design, hardwood floors on the inside. Definitely needs some love, needs some work. A boiler on the property, so the expenses are pretty high on the landlord in terms of heating all those units. There are 3 vacant units in the building. So the vacant units were different in July than they are now. So they had vacancies that they filled, and then more people left. They're underwriting 2,700 for a 1-bedroom here, which is pretty high, but they're getting it. There's 5, 6 units, 7 units or so that are getting that number. Again, that 5.57 cap rate is fabulous. It's, I kind of ran the numbers, it was almost closer to 6, but the agent's numbers were so screwy, it was not even really worth kind of studying them, but just based on what I was looking at. So with 3 vacant units at close to a 6 cap, you can almost absorb those vacancies day one, and not be cash flow negative. I mean, borderline, not quite, but you can jump in, renovate probably, and get those on the market ASAP, and be cruising close to a 6 cap in a A+ location. It's a $3 million building. Here's some photos of it, again, needing renovations. I just renovated a unit like this. It was around $45,000 to do kitchen, bathroom, floors, lighting, electrical panel upgrade. I kind of touched everything in a unit recently. And so units of this size are it's not too bad to renovate. And so,
did you get a sense of why it was back out of contract? I mean,
No,
it
I
was in
didn't call
contract for a long time.
I didn't call the agent. Said no fault of property, which tends to mean that something happened with the buyer.
With the
So,
buyer, they got cold feet or lost
Cold
their
feet,
funding or something.
couldn't come, couldn't close the loan, couldn't come up with a down payment, whatever it is. So, they may have discovered, usually when they write that, it's like they didn't discover a huge construction problem,
Yeah.
a huge defect or anything like that. So, they're underwriting at, these numbers are screwy. These are the agent's numbers, but 50%, speaking of the
Yeah, that down payment's not 50%, but
yeah. Yeah, down here you got the number right, but these are
yeah.
not my numbers. These are not my numbers. So speaking of the local lenders, who are a property like this is in their wheelhouse, they're probably, you can get 70% LTV out of this. So you can 900,000 down
Mhm.
to get into this building. And so I like it.
Yeah.
I like it. I primarily studying this building, I'd be primarily interested in really getting down to that deferred maintenance. What are my costs looking for? Because it's definitely a building that they have not put a lot of money into, and so
Right.
these are numbers that come back to a nice picture of it. That would be my red flag here, in terms of what are my big costs that are potentially coming down the line here. But other than that, it's close to campus. It's you attract professionals. You can attract Cal students. It's no parking, but that's okay over here. I don't really have an issue with that.
Right.
and especially has 1 bedrooms. So yeah, nice building. Happy that it's back.
That is a good one. That's interesting to see that it's back.
Yeah.
Yeah.
So that's what I have going on now. You know, looking at the San Francisco market, there's still some properties that are nice. Almost everything has vacancies in it. I mean, it's just it's amazing. It's every once in a while you catch one that's full. And you know, there's a couple deals up in the higher 4 caps that are full, that are interesting. They're certainly like a lot better than anything you'd find last year. Nothing that jumped out at me of like, oh, you have to have this right exactly now. But there are wonderful properties available. I mean, things that normally would have been snatched up or kind of sitting out there. But it's just obviously really hard for people to justify buying buildings with vacancies in it. To take that challenge on right now just is very, very daunting.
It is. Everybody's wondering what's coming in the future, and not at all certain about the prospects. I mean, I think in 9 months or a year, we'll probably be looking at a different picture. But it's awfully dark times right now. So
yeah, and everyone just they're just sitting on capital and stuffing it away and figuring out when to pounce again. But it's going to be that fine line of, you know, you don't want to pounce and everybody's pouncing, right? So
that's right.
Finding that sweet spot is the trick.
That's exactly right. Well, thank you, Josh. That's very interesting to see that one's back. And thank you for the update on the lending market. And yeah, I mean, it's probably going to be a long time and very difficult for the banks to get off of those 3+% interest rates and start actually charging real money for a loan. So you know, we'll see what life looks like after the economic activity starts to recover. But very good. Well, thank you, everybody. I will. I still haven't decided whether I have much more to say for the rest of this year, because with that depressing news, I'm not sure what else is going to happen. But I will let you guys know on Monday whether we'll have any more calls this year. I may just take a little bit of extra time off in December and be back at it in January. But it's great having everybody. Thank you very much for joining me. And I will be seeing all of you again very soon, I'm sure. Thank you very much. Take care. And thank you, Denise, for joining us. Thank you, Josh, for all of your wonderful presentations and the deals of the day. And I'll wish you a happy holiday season. Try to a quiet holiday season and a healthy holiday season. All right. Take care, everybody.
I want to say thanks before you go.
Yep. Thank you, Priscilla. Yes.
This would have been a very difficult year to navigate on my own. And I'm very grateful to have RMC with me.
Well, I'm really grateful to have you as well. And you know, everybody who shows up to the calls and contributes and is interested in their business is just a pleasure for me to work with. And, you know, especially for you, having been actively involved in this business for a long time, that means a lot. So thank you very much. I appreciate that. And thank you for your time in your business. And thank you, everybody. Take care. Have a wonderful rest of the season. Take care.
Bye.
Bye.